Good morning. CRE lenders shift from extensions to enforcement, and 2026 becomes a price discovery year. So, for years, commercial real estate has operated under a quiet assumption that rates would normalize and valuations would recover, and lenders would continue granting extensions. Well, that phase is ending, and CRE lenders now are moving decisively from extend and pretend to enforcement. Rising defaults, special servicing transfers, and forced refinancings are driving price discovery, particularly in the office sector. So, for disciplined investors in Texas, 2026 is shaping up to be a preparation window and not a panic year. The national reset from patience to enforcement. And the numbers tell the story. Office CMBS delinquencies reached 12.34% in January, the highest since 2000. And approximately 25 billion in CRE loans are past maturity right now. Nearly 100 billion in loans matured this year alone, with over half unlikely to refinance on time. And refinancing costs are often 300 plus basis points higher than their original coupons. So underwriting has shifted materially, whereas now we're seeing higher debt yield thresholds, lower leverage, so lower loan to value positions, but also stronger liquidity requirements from our sponsors with tighter DSCR standards. And this is no longer cyclical stress, it's structural repricing. So, in particular, hybrid work has permanently altered office demand. And in several markets, falling effective rents and declining valuations are creating zombie office buildings in slower growth metros. And high profile assets nationally have entered special servicing after repeated maturity extensions. Meanwhile, total US CRE debt sits near 5 trillion, with banks holding roughly 36%. And regional lenders, not large national institutions, are now entering what analysts describe as peak stress conditions. So, what this means for Texas commercial real estate? Well, Texas is not insulated, but it is positioned differently. So, let's talk about the office sector. And there's a selective reset, not a collapse. So, markets such as Houston, Dallas, and Austin faced elevated vacancy, particularly in the central business districts in Class B, but also commodity Class A products. Now, however, Texas naturally benefits from continued population inflows, from corporate relocations, from energy, medical, and logistics employment drivers. But also, there's no state income tax. But in Houston specifically, what we could see are some potential note sales or recapitalizations or some adaptive reuse strategy on some older office product. But there could be selective foreclosures as well. And nobody wishes that on anybody. But a suburban medical office and specialized build to suit products remain materially more defensible than a generic office building is right now. And price discovery will likely begin with older Class B assets before repricing stabilizes the higher quality inventory in the Class A sector. So let's look at industrial in Texas's anchor sector. Industrial remains Texas's stabilizer. In Houston's corridor along I-10 West, the Grand Parkway, and the port-driven logistics networks continue benefiting from e-commerce demand and distribution demand, but also energy infrastructure projects. There's some reshoring and manufacturing sites being moved around right now, but also there's continued population growth. People are moving here. And even cap rates compress modestly. Industrial fundamentals remain stronger than office. So you may see some capital exiting distressed office allocations, and they'll likely end up reallocating into industrial, but also grocery anchored retail in Texas. So, third is regional banks. Let's look at their liquidity and discipline. And Texas has a deep footprint of regional community banks active in construction and CRE lending. And as extensions become harder to justify, leverage offers will decline, so they'll be a little more conservative, but they're probably also going to require higher equity requirements. And bridge lenders and debt funds will have to step in just at higher pricing. And that's the real pain point, is we got to figure that out. But sponsors with liquidity and disciplined underwriting will have access to acquisition as well as note buying opportunities. So there's money to be made. And this is where capital structure discipline becomes critical. So deals underwritten at 3% just don't work the same now that you're refinancing at 6 to 8%. And that reset compresses proceeds and forces hard decisions, is the point. So let's look at 2026 as the preparation window. And 2026 is shaping up to be a true price discovery year, especially for office buildings. And for Texas investors, what this means is we're likely going to see some more realistic valuation benchmarks coming through. More likely some motivated sellers on maturity type assets where they've got a balloon note. But there's also recapitalization opportunities. And select industrial and retail acquisitions are going to make sense at adjusted yields. And the shift from extension to enforcement is only going to accelerate pricing transparency. And the point is, preparation beats prediction. An exit strategy starts on day one, and that debt yield matters more than pro forma IRR. But distress does not destroy markets. It transfers assets from weak balance sheets to strong ones. So put yourself on the strong side. And for disciplined Texas investors, that's not a threat. It's an opportunity cycle. So we got to keep our eyes open. The bottom line is that the accommodation phase is ending and it's time to pay the piper, so to speak. Enforcement is rising and office faces structural resets. Industrial still remains comparatively resilient as far as an asset class, but regional banks are tightening. And 2026 is becoming a price discovery year, is where we keep coming back to. Texas will not avoid the reset, but it may convert distress into opportunity faster than slower growth markets, is the point. And if you're underwriting deals in Houston, Katy, Fulshear, or along I-10 West, the question isn't whether prices will adjust. The question is whether your balance sheet is ready when they do. That, my friends, is it for the day. Please reach out. My website is houstonrealestatebrokerage.com. You can figure out how to get a hold of me there, and love to talk to you more. Have a good day.